Wall Street is bracing for the impact of President Trump's sweeping tariffs, set to take effect on Wednesday. As the financial world reacts, Trump has made it clear that he is indifferent to potential price hikes on automobiles as a result of his new policy. Speaking to NBC's Meet the Press moderator Kristen Welker, Trump stated, "I couldn't care less. I hope they raise their prices because if they do, people are going to buy American-made cars. We have plenty." When asked whether he had cautioned auto executives against raising prices, Trump responded, "The message is congratulations. If you manufacture your cars in the United States, you're going to make a lot of money. If not, you may have to move your production here, because domestic manufacturing won't face these tariffs." However, many vehicles built in the US still rely on foreign-made parts. Following the interview, a Trump aide clarified to NBC News that the president's comments specifically referred to foreign-made vehicles, not American-made ones. Later, aboard Air Force One, Trump reinforced his position, emphasizing that automakers producing cars in the US will profit significantly, while those manufacturing abroad will face higher costs due to the tariffs. Market analysts are closely watching the economic ripple effects. CNBC's Frank Holland noted that stock market futures were trading lower across the board, with the S&P expected to open down by 1% and the Nasdaq seeing an even greater decline. Concerns are mounting over how these tariffs could influence consumer spending, as estimates suggest they could increase the price of a new vehicle by up to $10,000. Edmunds has projected this increase, while other estimates vary. The complexities of the auto industry further complicate the situation. Many vehicles, even those branded as American-made, undergo multiple cross-border movements for assembly, involving parts from Mexico and Canada. This raises questions about how these tariffs will impact pricing and production logistics. Beyond the auto industry, markets are also responding to broader economic indicators, including Friday's inflation report and the University of Michigan's consumer sentiment study, which predicted inflation at its highest level in over 30 years. Additionally, April 2nd, dubbed Liberation Day by the president, marks the official implementation of the new tariffs. The tariffs include a 20% levy on all Chinese imports, as well as a 25% tax on steel, aluminum, and certain imports from Canada and Mexico that are not covered under the USMCA trade agreement. The 25% tariff on foreign-made cars and auto parts is expected to affect not only international automakers but also US manufacturers that rely on globally sourced components. For lower-income consumers, the impact could be particularly severe, as many vehicles priced under $30,000 are produced outside the US. Automakers argue that manufacturing these lower-cost vehicles domestically at a competitive price remains a significant challenge. Goldman Sachs has also weighed in on the economic repercussions, raising the probability of a recession from 20% to 35%. The investment bank also revised its forecast for Federal Reserve rate cuts, now predicting 3 instead of 2. As uncertainty grows, investors, economists, and consumers alike are closely monitoring how these tariffs will reshape the market and the broader economy.